We've gone from an October 2025 all-time high, 126,000 or so. Here we are as I speak, we're at 66,800. What happened?
The easy conclusion is to say like, okay, it's attributable to the halving. It could very well be attributable to the business cycle itself. And what was funny about the previous 3.5, 4 years was like, we did see the bull market in Bitcoin, which started in like early 2023, late 2022. But at the same time, like the US business cycle, especially US manufacturing, has been mired in a contraction.
Which is counterfactual to, or counter-cyclical to what we've seen in previous Bitcoin cycles.
Exactly.
We've seen Bitcoin go from 15,500 to 126,000.
Without any kind of tailwind from the macro side. In my view, we've seen like a bull market in institutional demand, while retail has been mostly absent. I think that could come back, and we could talk about the catalysts. I think a revival of like the US business cycle is definitely one of the catalysts. At the same time, many people think the crash in Bitcoin, this 50% drawdown, is somewhat of a signal that the business cycle is turning. Bitcoin tends to be this canary in the macro coal mine. The question is, of course, are we moving into a recession, or is this like a massive discount of macro expectations by Bitcoin? If a US recession doesn't materialize, this is like a massive kind of undervaluation by Bitcoin.
AI needs a currency. And so more and more it's looking like that currency could and logically should be Bitcoin.
It's already happening. It's just a matter of time. And I think in terms of the growth in that area, it's insane. I've never seen anything like it. It's even faster than exponential. That could be one of the wild cards for 2026.
Gold has been on a bit of a bull run for about 3 or 4 years now, since the last Bitcoin bull market. Do you think it's credible that there's a sovereign bid on gold?
The fact that gold is able to rally like this, for me, is a testimony that they're not able to control the gold price anymore, that the control is in China. I think the only card, and probably that's the card they're playing or trying to play, the only card that the US has right now is to establish a Bitcoin reserve, right?
Archie.
Andre Dragosch, welcome.
Thank you. Thanks for having me.
Oh, it's my pleasure. Now, a lot of people may be familiar with you if they're following the timeline on Twitter, on X, but tell us a little bit about what you do.
So I'm European head of research at Bitwise, and most of my time I analyze Bitcoin because it's the major asset. And what does Bitwise do? So Bitwise is a crypto asset manager, specialized crypto asset manager. So only managing crypto assets and crypto equities. And we manage around $15 billion in client assets, probably a bit less after like the most recent drawdown, but around that number. And we have offices in San Francisco, New York, London. We have an office here. And I think in Europe, we're around 30 people, but worldwide, we're around 120-ish people, but growing every day.
The reason why I'm very happy. I'm so happy that you've come into the studio because you're based in Frankfurt.
Yes, that's right.
And you wrote a really interesting article about Bitcoin. There's a lot of conjecture about what's happening with Bitcoin. Why is it happening? And, as is usually the case, narrative follows price. And we've seen price do, some interesting things that, not many people anticipated. Some people certainly did, but we've gone from an October 2025 all-time high, 126,000 or so. And here we are as I speak, we're at 66,800. What happened?
There are probably many theories, but from an on-chain, let's start with the on-chain perspective. I think if you look at the data, you can quite clearly see that there's been long-term holder selling, right? It started around the summertime already. You saw these news about Satoshi era coins coming to the market, very old coins that have been inactive for sometimes 10 plus years were moved onto exchange and liquidated. Compared to previous cycle peaks, that was quite significant. We saw around 700,000 Bitcoins, I think in Q4 alone, that was sold by long-term holders. So long-term holders in this context means investors who have held for at least 155 days, right? So I think the selling pressure was more like idiosyncratic, right? While the macro environment was and still is, in my view, very bullish, right? But yet you saw this kind of long-term holder selling. And yeah, then we dumped, I think Q4, we peaked in Q4, right? And it could have been related to any kind of reason, right? I mean, I think the common kind of reason is quantum, right? Quantum risks, but could also be related to the belief in the halving cycle, because it's somewhat weird, but we actually followed the halving cycle to the T. Our prediction at Bitwise was like the 4-year cycle is dead, right? The halving cycle is dead, because from a pure quantitative perspective, right, if you compared the supply deficit induced by the halving compared with like institutional demand, like institutional demand in 2025 has been like 4 times bigger than the supply deficit induced by the halving. So from a pure quantitative perspective, it has become way, way less relevant, right? So we thought, based on this kind of observation, okay, we think this kind of halving effect is not so relevant, and it's not irrelevant, but not so relevant anymore because of institutional buying, etc. And that's why we thought like the 4-year cycle was dead. But yeah. But the weird thing, we actually topped in October, right? And we followed the median performance, the post-halving performance, based on these previous cycles to the T, right?
Yeah.
And we followed this kind of post-halving performance, and we're still following it, right? And that could have been one of the reasons.
Couldn't it be that you can be both right and wrong on that, in the sense that the halving quantitatively does not really have an impact on the supply and demand of Bitcoin, and that's quite clear to see, right? But there could be a remnant from a cultural, psychological point of view that still persists and drives market sentiment to some extent, and then leading into other factors that you were going to discuss as well.
Exactly. I mean, you can be right or wrong. I mean, maybe it's a kind of self-fulfilling prophecy, because based on the past bull cycles and bear cycles, you've seen this effect, although there is a case to be made for that previous cycles haven't been caused so much by the halving itself, but by the macro cycle, the business cycle, right? Because the halving events, they've actually coincided with business cycle troughs in the US, right? So 2012, you saw this kind of business cycle trough because of the euro crisis. 2016 was because of this yuan shock and manufacturing recession in the US. 2020 was because of COVID, right? And 2024, 2025 was because of the tariff shock, right? We also had a kind of business cycle trough, right? And so you have this kind of coincidence. And so, of course, the easy kind of conclusion is to say like, okay, it's attributable to the halving, but it could very well be attributable to the business cycle itself, right? If you look for, and I've posted that chart, I think a couple of weeks ago, there's a funny kind of, it's actually a very strong correlation between the deviation of Bitcoin from the power law trend, which is, in my view, essentially like long-term adoption trend, right? Structural adoption trend. And so this deviation and the ISM manufacturing index.
So I just want to take a pause and quickly just define a few terms, because when people refer to the business cycle, and we'll do that with liquidity as well, but when people refer to the business cycle, what do they mean? Because we hear ISM, PMI, all these different indicators and indexes and indices, and so we don't know what they're actually specifically referring to, and whether it's a global measure or it's a local measure like the United States. So like, how do we set the context for that discussion?
Very good question. So ISM manufacturing index is a purchase manager index. It's a survey of purchase managers in the US. And ISM means Institute for Supply Management. That's like the institute that's doing the survey. And it's a monthly survey, right? It's a kind of sentiment index, but business cycle sentiment survey. And so like the ISM manufacturing index, it's a local index and is also tied to manufacturing. But it has become somewhat of the gold standard for like the business cycle, even the global business cycle, because it has a very long history. I think the ISM survey starts in the 1940s already, or even 1950s. So very long time series history. The US has been up until the 2000s the dominant economy, like on worldwide, right? Has been overtaken by China, but it was and still the second biggest, right? Worldwide.
And the methodology relies on it's not a quantitative measure, is it? It's like you said, it's a sentiment measure. So
it's a kind of sentiment measure. So this index fluctuates around 50, and 50 is like the neutral line. Anything above 50 is expansion, right? Implies expansion and like a positive outlook by these purchase managers. And anything below 50 implies contraction, right? And what was funny about the previous 3.5, 4 years was like we did see the bull market in Bitcoin, which started in like early 2023, late 2022. But at the same time, like the US business cycle, especially US manufacturing, has been mired in a contraction for essentially 3.5, 4 years. Like this ISM manufacturing index has been below 50 all the time.
So the Bitcoin bull market has been occurring during a time of ISM contraction.
Exactly.
Which is counterfactual to or counter-cyclical to what we've seen in previous Bitcoin cycles. Usually it correlates with an upswing in one, results in an upswing in the other.
Exactly.
But now we've seen Bitcoin go from 15,500 to 126,000.
Exactly. Yeah. Without any kind of tailwind from the macro side, in my view, right? If you talk about liquidity, there are different kinds of implications, but
we can get to that.
Yeah.
But first of all, I can't let the conversation go without discussing why that is. Why do you think that happened? Because I know in the course of 2.5, 3 years since the bottom of the bear market, we've had enormous institutional adoption.
Exactly.
And we were just talking about that was a new layer of demand that came into Bitcoin. We had the ETFs, we had, banks allocating or recommending an allocation. So like, is that alone accounting for Bitcoin going up while ISM contracted?
I think retail was mostly absent. If you look at Google Trends for like search terms for like Bitcoin or crypto, I think it was mostly below 50, right?
Yeah. No, it's been a 3-year bear market of Google Trends.
Exactly.
Searches,
you probably notice it in like YouTube clicks, right?
Yeah.
Like we're way below the levels, and we just talked about this before the show, right? We're way below the levels of like 2021, when we had like huge retail interest in crypto assets, right? So retail was largely absent, right? And my explanation for this is it's because of macro, because the macro economy was like weak or weakening, right? ISM was in contraction, manufacturing was not doing well. If you look at consumer sentiment in the US, it's a very similar story, right? It actually correlates with like the crypto fear and greed index. So there's a connection there between like consumer sentiment, the economy, and like overall crypto sentiment. And so, but at the same time, Bitcoin was grinding higher, right? You mentioned we went from like 15K to 126K without any kind of significant tailwind from the macro side. And of course, it's been due to significant buying by ETPs, so exchange-traded products around the globe, especially US ETFs starting in January 2024, right? And we've seen huge demand from ETFs, right? They've bought up multiples of the new supply every day, right, in the bull market. Same for treasury companies, and MSCI is still buying lots of Bitcoin through Stretch, right? Issuing Stretch and buying Bitcoin. But I think there's definitely a bull market and a structural bull market in institutional demand, because we went from around like 2 to 3% of Bitcoin supply owned by ETPs and treasury companies, I think, before 2024. And then it took off. Now they own more than 12% of the supply, right? And if you account for sovereign holdings, it's even way higher. It's closer to 20%, right? So we've seen like a bull market in institutional demand, while retail has been mostly absent. And I think that could come back, and we could talk about the catalysts. I think a revival of like the US business cycle is definitely one of the catalysts, right? And you already see job openings, to be fair, they've been very weak, right? You have this fear about like AI replacing white collar jobs and stuff. And it's true. But you have to use a magnifier, right, to see like the increase in productivity and output per hour and so on. Mm-hmm. It's happening, but it's not like as strong as many believe, at least in the data, right?
I want to interrupt you there because I want to get onto the institutional adoption and catalysts for retail in a moment. Yes. But I want to finish the point about the business cycle and the ISM. So if Bitcoin has been going up while that's been contracting for 2.5, 3 years, where are we now with respect to the business cycle? And what are some of the catalysts or headwinds, tailwinds that you see that could propel us either way?
So in terms of the US business cycle and global business cycle as well, I think we troughed in early 2025 again. It was somewhat of a reset because of this tariff shock, Like because of tariff shock, like you saw this drawdown in equity markets, in the ISM as well. Some of the components were like very deeply contractionary, right? So we had a kind of reset of the business cycle. Right. Yeah. And since then, a new kind of recovery.
We also had, a semi-war as well with the strikes on Iran. And there was
exactly.
Yeah, an open 12-day war. It's a full-blown war between Israel and Iran for that time. And that would have put a dampener on things. It's almost like the Trump administration is, foot on the pedal, foot on the gas at the same time. And we're just about approaching perhaps round 2 of that war now. And it's like we can't really get any clean air, clean run at the markets.
That's probably like a structural thing. But I think what happened in 2025 was because of this tariff uncertainty and like global economic policy uncertainty hit like a record high. But the good news is, and the consequence of this kind of peak uncertainty was central banks started cutting rates. Right, they eased monetary policy, and not only the Fed, right? It was also Bank of England, ECB, was National Bank, except maybe Bank of Japan. But all of these major central banks cut rates. They cut rates the most since 2009, since subprime. So COVID was an exception. Like every central bank went like crazy. But the post 2025 rate cuts were the highest since 2009, since subprime, which is insane, right? And so this tends to be a leading indicator. It tends to lead even like these very forward-looking indicators, not even the ISM. I'm talking about like even 6 months expectations of like manufacturing activity, like Empire State future activity, Philly Fed future activity, all these like very forward-looking expectations-based indices and surveys, which are essentially animal spirits, about the business cycle. And the liquidity cycle and this kind of central bank rate cutting cycle leads these indicators. That's why I think the growth picture will stay robust in 2026. So on the macro, will stay very robust. At the same time, many people think, right, the crash in Bitcoin, this 50% drawdown, is somewhat of a signal that the business cycle is turning, right, decisively, that liquidity is turning, that financial conditions are like tightening significantly, because Bitcoin tends to be this kind of canary in the macro coal mine. But the question is, of course, are we moving into a recession? Is liquidity tightening that much? Or is this like a massive discount of macro expectations by Bitcoin, right? Because if a US recession doesn't materialize, which I don't expect, if a US recession doesn't materialize, this is like a massive kind of undervaluation by Bitcoin, right? And we can talk about liquidity metrics as well, but as far as I can see it, there is no such thing as peak liquidity right now. But we can talk about this as well.
You're saying the business cycle troughed, so bottomed about 9 months ago, maybe even 10 months ago.
Yeah, around
now. So we're talking April, March, right?
Yeah, exactly.
If that's the case, isn't that too short a time for conditions to just reverse? Because my understanding is business cycles, it's like like turning the Titanic, right? It's going to take some time to do that. So 9 months seems to me to be quite a short time to go from bottoming to topping, right?
Exactly. I see it the same way. So not only in terms of duration, but also in terms of liquidity and leading indicators of liquidity, right? I think Michael Howell just published a piece about we've reached peak liquidity, right? But if you look at things like global money supply growth, right, it's still growing at a plus 10% year-over-year rate, right? If you look at things like central bank balance sheets on a global basis, not only the Fed, right, but also like Bank of England, the major ones like People's Bank of China and so on. I mean, it's stalling, right? But it's not like we are falling off a cliff or we're contracting significantly. Not like we did, for instance, 2022 or 2019. We saw a massive contraction in both liquidity, central bank reserves, right, and global money supply, which was totally consistent with like a Bitcoin bear market. We don't see it this time. To the contrary, right? All of these indicators are still accelerating. So we're still far away from any kind of peak in liquidity, right? Maybe the growth rate is peaking, but even if you look at US money supply, it looks like it's peaking. Like if you look at things like US M2 money supply, has plateaued or flatlined around 5% year-over-year growth. But there are leading indicators that you could look at. For instance, a good leading indicator for US money supply growth is the yield curve or the steepness of the yield curve. So essentially like the term spread between like 10-year US Treasury yields and 2-year US Treasury yields. And this continues to steepen, right? This continues to widen that spread. And I think it reached a new cycle high in February. It has come down a bit more recently, but still doesn't look like it's turning the corner, or reversing. So there's no imminent kind of trend change visible in these leading indicators, right? And the reason why the yield curve leads US money supply is because banks are incentivized to create more loans, right? To create more money because they have a higher interest rate margin, right? Because they tend to lend over the long term and refinance over the short term. So this is essentially like a proxy for the interest rate margin, right? And so there's at least as far as I can tell, and when I look at all these indicators, including the US 10-year yield itself, like the 2-year change in the US 10-year yield also tends to lead US money supply growth, right? And there's no indication whatsoever that this is turning around, right?
I guess all of which leads me to ask the question, what else has been going up? Because when we have a look, stocks are pretty close to all-time highs. Gold and precious metals have had a massive run, probably for different reasons. And yet Bitcoin has tapered off. It's 50%, more than 50% down from the peaks of October right now. And now all of those may have different reasons for their movements, right? So perhaps we can break that down, because we've seen recently one particular correlation that has been gaining traction on the timeline is Bitcoin's correlation with, is it the S&P Software Index? And perhaps we can go into that because once we understand, I guess, the different asset classes and why they've been moving, perhaps we can go into whether or not Bitcoin is a leading indicator or the canary in the coal mine, as you put it.
That's a very good question. I think there might be a connection between all of these assets. So precious metals, gold, silver, the NASDAQ, Max 7 stocks, equities in general, right? And Bitcoin, right? Which is, I think, the underlying denominator, which is common to all of these assets, monetary debasement, right? Because you could argue that even Max 7 stocks are scarce because they have like monopolies, right, in their industries and so on, right? If you look, Amazon's a prime example in online retailing, right? There's nothing like Amazon.
Yeah, so they can issue stock. That's not the scarcity pit. Their value comes from their ability to capture the excess monetary value within the economy through their their advertising networks and their moats around their businesses.
Exactly. But they're somewhat scarce, right? If you look around the globe and you try to find something similar like Amazon, you could probably only tell, maybe you could say Alibaba in China, but it's a fraud with like geopolitical risks, right? Some might say, like some international investors might even say it's uninvestable because it's China, right? So there are like not many games in town, right, where we can play like an online retailer like Amazon, right? Or something like Google, or, so they have these monopolies for portfolio managers. They called it TINA, right? There's no alternative. So even though these stocks have like excessively high valuations, they have like higher valuations than during .com, right? And there's like excessive concentration in a couple of names, right? The Mag 7, Mag 10. The problem like a traditional financial portfolio manager faces is he has to outperform or at least keep up with like a global benchmark, which is dominated by US equities, which by derivation is dominated by these Mag 7 stocks. So, and these Mag 7 stocks have outperformed like the S&P 500. So the only way not to even underperform is to own these stocks. And so you end up in this kind of suboptimal equilibrium where global portfolio managers have to own these stocks. Right? That's why they're so overowned. And but I think in terms of like AI bubble, when is it going to pop and so on, I think it's not imminent, right? Because you essentially need two necessary conditions for any kind of financial bubble to pop. It's decelerating profit growth or even contracting profit growth and tightening monetary policy. Right. And we're not seeing any of this. Right. So, but I do believe because of the relatively high correlation between like the NASDAQ and Bitcoin, there's definitely a risk down the road, but it's not an imminent risk, I think. And the fact that software stocks sold off might be somewhat related to like marginal tightening financial conditions. Right.
And what does that mean? A tightening of financial conditions? What does it allude to? Because in 2025 we saw rates come down. What else determines financial conditions?
So what you usually look at is things like high yield spreads, right? What's the risk premium like high yield companies have to pay over investment grade, right? Or the VIX itself, like the S&P 500 volatility index. So both high yield spreads in the US and the VIX actually increased starting 2026. And also things like the dollar, right? But it has actually depreciated, which is good. Like a depreciation of the dollar usually implies loosening financial conditions, especially for emerging markets who are usually quite indebted in dollar terms, right? They have dollar-denominated debt outstanding. So any kind of depreciation of the dollar is a tailwind for these guys, And that was definitely a net tailwind, but I think the slight increase in high yield spreads, VIX, is definitely like an early signal for some kind of tightening, but it's not as crazy as we've seen, for instance, during the tariff shock, where like the VIX spiked, high yield spread spiked, right?
For people at home, that's just an indication that investors want a higher price for the risk.
Yeah, they want a higher risk premium, right? They want to have a higher compensation for holding this kind of asset, for instance, high yield bond. And whenever these things increase, right, like high yield spreads or the VIX, it's usually associated with downside, like in the equity market. The question is, will high yield spreads continue to widen? Will the VIX continue to grind higher, right? And I don't think so, because you don't have this kind of tightening in monetary policy, right? To the contrary, I think, if you look at Chinese monetary policy, right? they're actually reflating the economy old school style like crazy, right? If you look at liquidity injections by the People's Bank of China, they've injected literally trillions of yuan into the banking system more recently. I think Michael Howell also said that the gold price rally that we've seen is mostly attributable to this reflation in China, not US, right?
So why are they doing that? Because their economy is ticking over at what, 5-6% a year. Where is the need for China to be reflating, as you put it, their economy with extra liquidity? Why are they doing that?
Maybe to avoid a hard landing.
A hard landing from 5 or 6%.
Yeah, because if you're highly indebted, which the Chinese economy is, right? It's highly indebted. Any kind of sector is highly indebted, except the fiscal side, right? But the private sector is highly indebted. So it's reliant on refinancing and so on. So you need to create these credit cycles, bull cycles all over again, right? You need to reflate all the time. And what we've seen actually is we've seen like a reacceleration in Chinese credit growth, right? And money supply growth. And this tends to lead metals prices, commodity price, like industrial commodity prices, raw industrials, and so on. Stuff you actually need to build real things, right?
Yeah.
And they tend to lead, like this Chinese credit impulse tends to lead by around 9 months. And it's still not decelerated. It has flatlined more recently, but based on this kind of lead time, it means that commodity prices won't fall off a cliff anytime soon. That's the implication. They will probably stay at these very high levels for some time, at least for the remainder of 2026. And what's funny or what's interesting about the reflation in commodities, especially like precious metals and metal prices, is these reflationary periods were both associated with ISM expansions, right? Business cycle expansions and Bitcoin bull markets.
And yet, strangely, we're not seeing that right now. And so, you know, just to put the run of the gold price into a bit of context, gold has been on a bit of a bull run for about 3 or 4 years now. Since the last Bitcoin bull market, it has gradually been sort of edging its way up, and sort of on a larger time scale, it's been threatening to break out of a trading pattern. I forget the exact structure, but I think it might be pretty close to a cup and handle over like 20 years. And it broke out of that. So that's been building for some time. Is the Chinese liquidity injection just the sort of the kerosene on top of an already burning fire? And if that's the case, what has been leading up to it up until the last 9 months? Because there was a lot of speculation around that actually there is definitely a sovereign bid on gold, all part of the whole sort of BRICS alternative financial infrastructure, global financial infrastructure, as a result of the United States weaponizing its hegemony over the global financial system and its US dollar hegemony as well. And so like all of that sort of is out there. And this Chinese liquidity injection seems to be just like late stage, blow off top sort of fuel on the fire. But can you explain to us a little bit more context about the last 3 or 4 years of what's happening in gold? And do you think it's credible that there's a sovereign bid on gold?
100%. So, So I think there's a structural element and cyclical element. The Chinese liquidity injections more recently are probably more like cyclical. And this probably led to this kind of crazy rally we've just seen. But 100%, there's this kind of structural shift away from dollar assets, especially US Treasury bonds, by central banks into gold, right? You can clearly see it in the data. Like, in fact, de-dollarization has been accelerating more recently, right? Like, I think the dollar share in international reserves at the beginning of the 2000s has been close to 60%, right? And then it declined to around 50% over the past 20 years or so, right? So 10 percentage points lower, around 50%. And then Ukraine invasion happened 2022. The West froze Russian foreign assets, And then you saw an acceleration of that trend. You saw even like an accelerated pace in terms of de-dollarization, in terms of like divestments away from US treasuries and US assets into gold and also alternative assets, right? And that share in international reserves, that dollar share, has declined another 10 percentage points in just 3 years. So 20 years, 10 percentage points decrease. 3 years, another 10%. It's clearly accelerating. And now we're close to 40%. So the dollar share in international FX reserves is way lower than 50%. It's not even the majority anymore, right? And gold has even overtaken like the dollar itself. And that's why I think it's definitely consistent with like Ray Dalio running around saying like, we're seeing like the breakdown of the monetary order, right? And it's true. If you can clearly see it in the data, there's definitely like a persistent central bank bid on gold, right? Which started around COVID. I think after 2022, you saw like almost double the amount of central bank buying in gold per quarter compared to like the pre-COVID period. So that's when it all started. And I think, but the original sin was, of course, like this freeze of Russian assets. And since then, you've seen all kinds of structural breaks in the market. Like if you talk to commodities traders, like they will tell you, one of the best indicators, valuation indicators for the price of gold was, or used to be, the US real yield, right? The inflation-adjusted yield based on these TIPS, right? Treasury inflation-protected securities. And that completely broke down after 2022. Like real yields were still relatively high, right? Because of tightening by the Fed post-COVID and so on. They raised interest rates. So real yields were relatively high. But the gold price just took off regardless, right? There was complete decoupling from this kind of relationship, which puzzled many, many commodity traders. Mm-hmm. And I think since then, you're in a different kind of regime, macro regime, and this really kind of accelerated de-dollarization and hard asset regime. Because that's also the moment you see the kind of underperformance between, for instance, the S&P 500 and gold, right? So hard assets outperforming financial assets. I think that's the environment we are in right now. And in terms of gold, I think that central bank bid won't go away anytime soon, right? Mm-hmm. What will change like central banks, or what will change their mind? Probably nothing, right? They will keep divesting from dollar assets, especially like emerging market central banks like China, India, Russia, right? They will keep divesting and will keep buying gold, right?
And so I guess, we can, if we're going to look at China as being the lead cause for this massive parabolic spike in the gold price, the question I would have is like, why didn't that flow into Bitcoin? And initially, I guess the answer I would probably propose is that, it's not as readily available in China. But what would be your answer to that?
Yeah, there's this dichotomy. I think like Bitcoin has somewhat become this kind of US centric asset, because in truth, if you look at the biggest institutional buyers, MSCR, US based company, right? IBIT, US based, right? Biggest ETF in the world. FBTC, same, like Fidelity ETF. Our ETF, right, is also one of the biggest buyers. Sovereign, US sovereign, right? US government, biggest government holder, right? Sovereign holder. So it's a very US-centric asset. And if you look at things like the Coinbase premium, right? Crypto traders, they use Coinbase premium to assess whether there's like buying pressure or selling pressure in the market. Mm-hmm. Because Coinbase is the leading exchange, right? It's US-based. And you could tell, that gold is more like China-centric right now. It used to be the London gold market that dominated the gold price for a century or so, right? Then it moved over to New York, COMEX, and so on. But now, I think because of these trade deficits over the past probably like 30 years in the US, a lot of gold has moved to Shanghai and China in general, right? And you see like the gold vaults in Shanghai are even bigger than COMEX. So Shanghai has become essentially the most dominant gold exchange in the world. This is where prices are made. That's why you see these crazy premia, like Shanghai against like the London gold price.
Mm-hmm.
They're actually creating this kind of buying pressure, right?
Yeah.
So I'd say, so my thesis based on these kind of observations is gold is dominated by China right now. It's not dominated by the West anymore. But Bitcoin is dominated by the West, right? By the US in particular.
So if the liquidity is coming from China and gold is now a Chinese market, a Chinese dominant market, it makes sense that much of that liquidity is flowing into gold rather than Bitcoin, which is not as readily available as gold. And then we see, I guess, a little bit of momentum in the markets of global investors having a look at what gold is doing versus Bitcoin, and then perhaps some taking their money and reallocating.
Yeah,
and then you see this sort of self-perpetuating price action where one goes up and the other one goes down, and then it's like, well.
Yeah, in truth, I thought the combination that Bitcoin, if you look at Bitcoin versus gold, it tends to be like a risk on, risk off proxy, because in truth, like Bitcoin is still a risky asset. It's still definitely seen by investors as a risky asset. And gold is still this kind of traditional safe haven asset, right? Flight to safety asset. And so this relative performance tends to correlate with things like cross asset risk appetite across all kinds of assets, right? Equities, bonds, FX, and so on. So what you saw during like the most recent sell-off was Bitcoin against gold was oversold and undervalued. If you look at things like Mayer multiple, the relative Mayer multiple between Bitcoin and gold, it was at FTX style levels, lowest it has been on a relative basis since November 2022. Also things like if you do a regression analysis between Bitcoin and gold and global liquidity, also like more than 2 standard deviations to the downside, right? And so I think it's definitely undervalued in relative terms, right? But also in absolute terms, oversold. And I actually thought that you could see this kind of rotation between, especially from gold to Bitcoin, the moment you see like a renewed risk on. But we actually haven't seen that, right? We have actually seen even like a crazy outperformance by gold, and then another kind of sell-off in Bitcoin, which might be related. Because what you saw, especially during January, February, was like gold's volatility increased like crazy, right? You had this kind of massive spike to the upside. And then also like strong correction. Well. Exactly. I think silver corrected like more than 30% in a single day. Massive volatility, the biggest percentage decline since 1792 or something, right? Like crazy volatility in precious metals. And usually what you also saw in January and February was significant outflows from macro hedge funds and these multi-strat hedge funds, right? And what they usually do is they tend to decrease risk during periods of elevated volatility because they trade in all kinds of assets. They trade in Bitcoin, and we know they trade in Bitcoin, like Schoenfeld, all these big global hedge funds. They trade Bitcoin ETFs, right? Plus, they trade gold, other precious metal, macro trades, right? And the moment these guys see an increase in volatility, they need to de-risk. And my thesis is they probably needed to de-risk in Bitcoin. So that's why the moment you saw this downward spike in gold, Bitcoin also went down, which is somewhat paradoxical when you think about this rotation rationale, right? So that's at least my explanation why you saw another leg down despite this kind of peak in the gold price. But I think the good news is we should actually cheer for gold rallying, precious metals rallying, because it increases the TAM, total addressable market for Bitcoin, right? Because we know at some point Bitcoin will eat gold's lunch, or at least eat parts of gold's lunch, right? Because it has higher transferability, divisibility, verifiability, and so on, right? In a world where you have adversaries, let's say like US and China, right? But they will still do some trade with each other, right? They're the biggest trading partners by far still, right? Despite the tariffs. So you need an apolitical currency. And imagine you have to settle gold between US and China in a kind of very low trust environment. Like it's almost impossible. And even if you have tokenized gold, it's impossible because you want to have the underlying, the physical gold. You know, in the ultimate settlement, you want to have the physical gold. And then you have transportation costs, right, and so on. It's impractical, I think, in a world where we're moving towards, right? In a kind of, world with adversaries and so on.
Well, there were
multipolar world.
There were two sort of kind of complementary, also competing narratives about why Bitcoin had that horrific unwind almost a couple of weeks ago now. And Jeff Park, your former colleague, and he's still an advisor at Bitwise, and a fella called Parker, I think, I forget the full Twitter handle.
Parker Lewis.
No, it wasn't Parker Lewis. It was something or other. Parker something or other. I should get that name. But they had two, I guess, competing, slightly complementary narratives. But essentially, what they had in common was derivatives were involved. And so derivatives are a new sort of game in town when it comes to Bitcoin. They basically run the show now because their volume and the value is just so much greater than spot. When did you see that start to creep in and have a larger impact on the Bitcoin price? And what needs to happen for spot to become dominant again? Or will it ever?
I think, to be fair, I think it was a spot-driven market this time.
Oh, you do?
Yeah, I actually think it was spot-driven because open interest in either futures and options hasn't really changed during like the peak of the bull market. Of course, it has declined significantly during like the bear, but before then, you haven't really seen it. And
how does a spot market drive a precipitous fall in the price like it did? That seems to have all the sort of fingerprints of a derivative unwind.
Yeah, I mean, these spikes to the downside, they're usually caused by futures liquidations, right?
Okay. Yeah, but you think it started with spot?
I think if you look at things like institutional demand, combined purchases by both ETPs, US ETFs, European ETPs, and so on, treasury companies, it actually peaked around the same time we peaked in like October and then decelerated. I think Charles Edwards also showing these kind of charts, decelerate significantly in Q4. And you had essentially outflows, right, from ETFs, right, at some point. And I think only MSCR at some point was doing the heavy lifting, right?
Yeah.
Same in 2026, like most of the purchases, or I think all of the net purchases were done by MSCR in truth, right? They bought around 47,000 Bitcoins as far as I know. And in 2026 alone, right? The net institutional demand figure, if you account for ETPs as well, other treasury companies like Metaplanet and so on, was less than 30,000 Bitcoins. So there was even like lots of selling from the ETF side. And it tends to be very pro-cyclical, right? The bid by Saylor is more like structural, right? It's essentially up only. He's just
very
buying.
Consistent.
It's very consistent buying. But like these flows, in and outflows from ETPs, ETFs, they tend to be very pro-cyclical. And we've actually published a piece on this, it was like, I think, mid-2025, that it has become one of the dominant players for Bitcoin's performance. I think at some point in 2025, changes in ETP flows explain more than 50% of Bitcoin's performance variation. It tends to be a cyclical as well. It changes all the time, depending on the market regime. But like spot ETF buying has become the dominant force for Bitcoin, especially since 2024, since the ETF launched. And the reason is you see more trades in global ETPs in these shares, right? Than you see on-chain already. So a lot of like speculative demand has moved from traditional crypto exchanges to like traditional exchanges, like New York Stock Exchange. And that's a significant shift. That's why you see like low active addresses activity on-chain, and all of these on-chain data, all of these on-chain indicators, they've fallen off a cliff after the January ETF launch, right?
Yeah.
And that's why,
because
ETFs
you saw this basically
migration.
as a proxy for spot volume, exchange volume.
Exactly. It's now more dominant. And that's why you see all these theories about, Jane Street's manipulating the market. But Jane Street is just the market maker, one of the dominant market makers for the ETFs. So what they usually do is they experience a lot of redemptions. For instance, there are lots of outflows from these ETFs, lots of selling. And suddenly they have too much inventory, right, of these ETFs. And they hold an equivalent amount of both Bitcoin and these ETF shares, right? And what they usually do is if they experience too many redemptions, they have to sell off Bitcoins, right? And they usually do that at 10 a.m. New York time. That's when you see these downward spikes. They have to just get rid of their inventory. The price dumps.
Would such a sophisticated financial outfit really have to do something like that in such a predictable way that other traders can then front run? Like, wouldn't they, because, spot is a 24/7 market, right? Wouldn't they have processes and systems in place to say, okay, whatever the outcome of today's TradFi trading window was, we now have, 12 hours or whatever it is to sort that out?
I think not financial advice, but there's a possibility you can front run that.
Yeah. Well,
you have the data. I mean,
from the day before, right?
You have the data from the day before. That I think the in and outflow data, they are being published, I think, around midnight New York time, which is like 5 a.m. UK time, for instance. And the moment okay, there were lots of redemptions, you could theoretically, hypothetically profit from this. But that being said, I haven't tried out or haven't backtested any kind of trading strategy. And like I said, it's not financial advice, but there's definitely a time lag between these redemptions, net outflows, and market makers reducing their stock of Bitcoin, right?
We were talking about gold before, and I wanted to make mention of an observation I made from a chart that was posted. And someone was overlaying the Bitcoin price with the gold price. And I couldn't help but notice, and a few other people have pointed that out as well, that whenever the gold would run first, and as soon as it would plateau, Bitcoin went parabolic. And so now, are we seeing the recent volatility in the gold price an indication of, weakening bull run or a plateau of its price? Or is it just taking a short break before, heading to 10,000, for example?
Yeah, that's spot on, right? I'm also glad that you asked, because that's why we should cheer the gold price already, because we actually did a statistical analysis. We asked ourselves, is gold leading Bitcoin or is it the other way around, right?
Yeah.
You can do this by something which is called Granger causality test, statistical test. And what we found out was gold tends to lead Bitcoin, but not the other way around.
Yeah.
So it is a leading indicator for Bitcoin. That means, I think the Granger causality suggested, I think the most significant lag was around 4 to 7 months, around like half a year, So 180 days, right? That means gold price rally usually foretells a rally in Bitcoin, right? Also, that's why we should cheer the gold price rally, right?
Yeah.
And I think the mechanic behind it is gold price tends to rally in a risk off. And after risk off, follows risk on, right?
Yeah. So
And,
so that sort of implies there is a kind of capital rotation, but does it necessarily mean it's from gold to Bitcoin, or is it simply from risk off?
From risk off
risk
assets
on.
to risk on, I think. It's not necessarily from gold to Bitcoin.
Mm-hmm.
That would be ideal, because we also estimated you only need like a tiny percentage point or a couple of percentage points of gold's market cap to rotate into Bitcoin. I think it's around 5% only, because like the gold market cap's so huge already. It's above 30 trillion.
32 trillion.
Yeah,
so that's 30 trillion bigger than Bitcoin's, right? So Bitcoin's has contracted from just over 2 trillion to I think about 1.3, 1.4 trillion, which is still, quite an achievement given where we came from, right? But a lot of sort of people who are skeptics, borderline cynics when it comes to Bitcoin ask the question, where is the money going to come from? Where is the demand going to come from? And yet we've seen gold add like multiples of Bitcoin's market cap in the space of 6 months.
And even on an intraday basis, right?
Like it was nothing, yeah.
Yeah.
And so the money's there. It's just whether or not they allocate the Bitcoin. Now, the point, I wanted to make a point about, there is some confusion with people, with Bitcoiners in particular, about Bitcoin's properties being, it's a sovereign asset, it's a bearer asset, and it has no counterparty risk because there's no counterparty. And so as a result of that, they think because it takes care of the counterparty risk, that there is no risk with respect to how capital is allocated. And there's confusion with how can Bitcoin be a risk on asset if it is my hedge against the system imploding. Perhaps you got some thoughts on that?
Yes, of course. I mean, Bitcoin has volatility, right, which is market risks, but it hasn't got so many other things, right? Like credit risk, like counterparty risk, like liquidity risk. You can easily liquidate Bitcoin, even large positions, right? Massive trading volume, billions per day, right? So no liquidity risk, no key person risk or operational risk. We know Bitcoin's uptime is around 100% since 2013 or so. So no operational risk. In that sense, it has very similar properties to gold, right? But as, like I've said, it has higher transferability, divisibility, and so on. So it's technologically superior to gold, which is why I think over the long term, it will disrupt gold eventually, at least reach the same kind of market cap. That's quite realistic, I think, at some point. And which implies a huge kind of upside still, right?
Yeah, massive. Just based on what gold is right now. So it's 32 trillion, right? So that's that's more than 30x what Bitcoin is right now, right?
Yeah.
And so 30x Bitcoin's current price is about 1.8 million, something like that. So that's the current addressable market without factoring in any of the benefits of Bitcoin being Bitcoin, being digital.
And also not factoring in other stores of value, which are even way, way more inferior than gold, like US Treasury bonds.
Yeah, so I'm not saying that Bitcoin's going to absorb all the sort of value from gold. Gold is still going to be gold, but we're just saying Bitcoin has the potential. Gold has demonstrated the potential of Bitcoin. The higher gold goes, the higher Bitcoin can go as well.
Exactly. Yeah. I think what's interesting about Bitcoin's correlation to like other assets, store of value assets, like gold or US Treasury bonds is, and few people know this actually, Bitcoin is less correlated to US Treasury bonds than gold is. So Bitcoin in a kind of bond portfolio is a better diversifier than gold. And it makes, in this context, makes total sense that central banks are also diverse, like the Czech National Bank, they're trialing this kind of Bitcoin investment. It's like a tiny, tiny investment, but they have the same kind of rationale. We think like good diversifier, right? Because they mostly hold bonds and gold, right? So adding Bitcoin does make sense, right? It's a risk on asset, but it has these kind of very interesting correlation characteristics, especially to bonds, US Treasury bonds. And what's even more is during Treasury down days, Bitcoin outperforms gold. So even like in negative kind of bond markets, bond environments, Bitcoin is the better downside hedge than gold. And so we analyzed this, I think was like 2000, sometime last year. We call it the Bitcoin bond conundrum. And very few portfolio managers have actually realized this. This is not common knowledge, and we try to educate like investors about this kind of characteristic of Bitcoin. And as far as a Bitcoin allocation is concerned, in a multi-asset portfolio, what many portfolio managers are usually facing is you have like, for instance, 60-40 equity bond portfolio, and then you want to add Bitcoin, but where do you what kind of asset do you reduce? Right? Do you take it out of the bond bucket, or do you take it out of the equity bucket? Right? But it doesn't matter. It doesn't actually matter, right? You can even take it out of the bond bucket, right? Which is even better in terms of diversification, right? And that's, I think, one of the most interesting findings we analyzed, I think, last year.
Regarding the risk on, so, gold has got many thousands of years of, the cultural
track record.
It has a tremendous cultural track record. Once something takes a hold culturally, it's really difficult to dislodge that psychologically, culturally. It just becomes a global phenomenon and becomes self-perpetuating. Bitcoin, in just 17 years, in the age of memes, has done a tremendous job of developing narratives. But sometimes I think that we're often 5 or 10 years ahead because of what we project from the properties of Bitcoin. The properties of Bitcoin imply that the asset, upon maturity, will behave in a certain way. But it's still a nascent asset. It's an emerging asset. And so it behaves in ways that you've just described with respect to being a risk-on asset. The volatility, price volatility is there. And, as Michael Saylor has said many times, volatility is a gift to the faithful. How do you sell that message to, I guess we're tying up both of our streams of topics for this interview. How do you sell that message when you're talking to an institutional investor? Do they first need to be sold on the fact that Bitcoin is here to stay, and then you start talking about some of these properties and the potential behavior of Bitcoin down the track? Or do you have to deal with the here and now based on what the data is saying for the last 5 or 10 years?
Most of the time we just show them the numbers, right? But in terms of track record, I think it's somewhat like a false argument, because if you look at technological innovations, right, like the car or electricity and so on, I mean, there's like a gradually then suddenly kind of moment, right? If you look at cars, for instance, right? Before then, we used horses for transportation most of the time, right? For like millennia, right? But then we didn't, right? We just stopped using horses.
I think in the space of 5 years, it just flipped completely.
Completely flipped, right? You had this kind of suddenly moment. Same with fire, right? We used fire for like millennia, right? Suddenly you have light bulbs and electricity, right? It just flips. And or candles, right? So these kind of technological innovations, they tend to be disruptive, but mostly all at once, very sudden, right? And so I think the same is true for gold, right? We've been using gold for thousands of years, but it's not a guarantor that it won't be disrupted at some point, right? Yeah. At some point, it's probably some kind of suddenly moment where like this monetary premium in gold will just start to decline because it's not so useful as a monetary asset anymore, because the innovation of Bitcoin is not like it's scarcer than gold, right? We know it's hard capped, right, at 21 million, has a lower production rate, and will have like decreasingly lower production rate over time with every halving, right? It's not only that it's scarcer, and it has some like similar properties in terms of counterparty risk, credit risk, and so on. but it has this kind of transferability. It's like the combination of gold with PayPal. That's the innovation of Bitcoin, right? And it's also not a new PayPal either. It's really that combination between like hard asset and transferability.
Yeah.
So the best of both worlds, right? What I think Seifstein called a spatial and temporal salability, right? Because you can transfer gold's purchasing power over time, right? Temporal salability, but you can't really transfer it over. Send it anywhere. Transfer it over space, right? You can't send like a PayPal transaction easily over space, right? But like we know, fiat money declines in terms of purchasing power. You can't really save it, right? So you can't transfer in terms of time. But Bitcoin combines both of these worlds. That's the innovation via proof of work, because we actually bring physical scarcity from the real world via hardware expenses, energy expenses, into the digital realm. That's the innovation. And that's so cool about Bitcoin, in my view. So that's what we talk about in terms of like the track record and so on, technological innovation. And then we just show them the numbers, right? Like we also talk about counterparty risks and so on. And we talk about volatility a lot, right? Because it's one of the key concerns. But like there are a couple of observations with respect to volatility. So the first one is, if you look at Bitcoin's historical volatility, it has been in a structural kind of downtrend essentially since 2012, right? It has, I think Bitcoin's volatility in 2012 has been around 200% annualized. And now it's closer to 30, 40%, which is very similar to an S&P 500 investment, right? It's not so like odd anymore, right? So 200% to like 30%, massive decline in volatility. Of course, because of adoption, increasing scarcity, and so on. So structural drivers over time. And at the same time, the good thing about volatility is it implies vitality, right? Because it also implies high upside. You want to have volatility, right? To a certain extent. And the cool thing about Bitcoin, it has this kind of skew, right? Return skew.
Well, when I was speaking to Jeff Park, we were discussing how in the lead up to this current drawdown, that Bitcoin's volatility had been the lowest it had been in its history, essentially. But then we've seen the most rapid drawdown in Bitcoin's history as well. So is it a case of, volatility gets swept under the rug because of the way derivatives are now being used with Bitcoin, until such time that it just all sort of explodes either to the upside or to the downside? So we're seeing condensed periods of extreme volatility, and most of the time it's just, really low volatility now.
I think it was the biggest dollar move, but in percentage terms, it wasn't the biggest, I think. But anyways, I think we had like a God candle.
I think you're right.
In dollar terms on the 5th of Feb, right? And on the 6th of Feb, we had a God candle to the upside, right? So I think it was the biggest dollar change on a daily basis.
10,000,
Yeah,
so 10,000 down and 10,000 up.
Exactly. God candle down and up, right?
Yeah. I think the range may have been even higher, but the closing up and down was about 10,000.
Yes.
I may get that wrong, I'm not sure. But
yeah, I think what dampens volatility over time is adoption, because at the very beginning you just had cypherpunks, early miners, right? Like Hal Finney, Satoshi. So not a lot of adoption. And Mt. Gox, right, was the only exchange. That's where most of the trading happened. And most of these guys, because they were so similar in terms of investor profile, that probably is similar kind of information, right? Not different kind of information. So you get more volatility. The funny thing about stable markets and volatility is when you have consensus among investors, right, that they're essentially very homogeneous, you have more volatility. When you have when you don't have consensus among investors, then you have less volatility. So different types.
That makes sense. Yeah, it makes sense to me, because you're having buyers and sellers with different opinions.
Exactly, different opinions.
And so it takes the heat out of the market on an ongoing basis, whereas everyone trying to rush to the door at the same time.
The best example is like day trader and pension fund, right? For instance, day trader, probably uses like technical analysis, right? MACD or any kind of pricing signals, right? On a daily basis, just trades intraday, right? And suddenly he might think like, oh, this is like on an intraday basis, like selling signal, bam, sell. Like the pension fund, on the other hand, might think, oh, this is an attractive entry point for like 20 years plus time, right? Not on an intraday basis. Because he used like macro data, liquidity, different kinds of information sets, right? And they're actually in disagreement, right? Where the price is going, and they have different investment horizons. So, and I think this example shows the more like heterogeneity you have among investors, the more stable the market is. The extreme case is everyone agrees. Like, for instance, there's some kind of event where you have like massive uncertainty about something, and like suddenly the pension fund becomes like the day trader, right? The pension fund says like, oh, this is massive news, quantum risk, I don't know what, right? It's just like a random example, but say quantum risk, oh, we'll break Bitcoin. Day trader thinks the same, oh, we'll break Bitcoin, sell, right? And then you have these price dumps, right? Because there's like an agreement among all of these usually different investors, which creates this volatility in the first place.
I get the sense that of the sort of big money players, the fast money crowd has come first to Bitcoin before the allocations of the more patient funds like the pension funds. Do you see that bear out in the data, in the conversations that you're having as well? So hedge funds were sort of, let's do it. It's moving fast. It's got a chart. Let's trade it, right?
Exactly, yeah.
Whereas all the others are kind of like, well, what is this about? And let's take a 5-year time span to understand this and decide whether it's part of our strategy.
I think it's true. I mean, if you look at these different types of investors, the first ones have been crypto hedge funds, then traditional hedge funds, like Schoenfeld, all the others, right? And then you saw family offices, private banks move into it first before like the major banks. They tend to be more conservative as well. Same for pension funds, right? Endowments, they tend to be even way more conservative than like family offices and private banks. Private banks, they're generally more flexible in their mandate because they're very much client driven, right? And like the client says like, please add Bitcoin to my portfolio. I just want to have it. And they just say, okay, we make it possible, right? And they just buy it. And but I think what we are moving towards already is we're actually moving into like this kind of end game adoption of sovereigns, right? Sovereign wealth funds, even central banks are buying Bitcoin, right? It's not the big ones, and probably these guys will buy last, right? Like the ECB, like the very big central banks, they'll probably buy last. But I think the in-betweeners and the small ones, they probably buy first. Or I mean the Fed has not bought any, but like the US government itself has bought Bitcoin, which is also incredible, right? One of the biggest sovereign nations.
It bought Bitcoin?
Oh, confiscated Bitcoin. Sorry.
Yeah. It does hold
confiscated
Bitcoin.
And seized Bitcoins, right? It established a strategic reserve, which is massive in my view, still is. You've probably read stories about sovereign wealth funds like the Luxembourgish fund. They've effectively moved into Bitcoin. I think they've allocated 1% of their portfolio.
I think that came out not that long ago.
Yeah.
I recall the story.
And also Mubdala, the UAE sovereign wealth fund. So you already see that some of the like smaller ones are moving into Bitcoin, which I thought would be much, much farther away because they also tend to be more conservative. But it's this kind of domino effect, right? This kind of social proof, which is so powerful. I think social proof is like one of the most powerful drivers of adoption, because the fact that like a mid-sized or a large family office buys Bitcoin actually validates the case for a bigger player, like a bigger bank. And suddenly this kind of purchase validates the case for like a big institutional investor. And suddenly, because they talk to each other, right? It's a small world. And then like the institutional investor talks to his sovereign wealth fund friend, right? So it's like, oh, we bought Bitcoin. Oh, isn't it too risky? No, if you look at this, and so, right, they talk to each other, and so you get this kind of domino effect, right? And suddenly the sovereign wealth fund investment also validates the case for the central bank itself, right? Because they're also connected. And so you get,
that domino, that upward sort of domino effect. I see, a lot when I was posting news about some small buy by a state or a city or a municipality somewhere, and people would go, it's peanuts. Why are you bothering us with that? And you're like, don't disparage the small wins, because they all add up to something. They all add up to social pressure and social acceptance somewhere along the line. There are people on those boards who are probably CEOs at larger organizations or on other boards. And that consensus has to build up slowly. It's not just going to be somebody wakes up one day and allocates, $100 billion to Bitcoin. That may happen by sheer luck. But, people disparage, for example, El Salvador. It's only a small nation. You're like, yeah, but it's the first nation, right? So that gets the conversation started.
Definitely
Is it the Czech central bank? Okay, it's not a huge economy, but it's a central bank.
Exactly.
And it's a European country, and it's an EU country, and all of these things matter. They all add up. And
totally matter, yeah.
We can't just, in many ways, we don't want to leapfrog that process because it means the people and the nations that need it most get it first. It's the opposite of the Cantillon effect. But then, we post that kind of news and everyone's just like boring, yawn. And it's like, no, actually, like this is what you should be getting excited about, the little wins. The fact that, I posted the other day, paying with Bitcoin in El Salvador was actually quite boring. It just works. You ask, can I pay in Bitcoin? They say yes. They show you a QR code and you just pay, and that's it. There's nothing happens.
That's how hyper Bitcoinization.
Yeah. Nobody claps. There's no champagne bottle being popped or anything like that. It's just really boring, and it just works, and that's how you want it to be. And it's not until you realize how boring it is, how reliable it is, that you go, oh, we're really making some progress here. And okay, it's one beach town in El Salvador. It's not the whole country in every single shop. But in that beach town, it's pretty much 100% saturation. Everywhere you go, you can pay in Bitcoin. But you can't pay with card everywhere you go in El Zonte. And I got caught out because I didn't have Bitcoin with me. I thought it would be like 3 years ago where, they have a sticker at the shop, but it takes a while to get the point of sale system up, and maybe then there's not enough liquidity in the channel. I didn't even bring any Bitcoin, and like the first day I couldn't pay because I only had card. I was embarrassed, and it was like, okay. I had to top up twice after that. So like I paid all my coffee with Bitcoin, a couple of restaurants in Bitcoin, some burgers with Bitcoin, and I ended up spending maybe $500-600 just in Bitcoin. So, it was
lots of rewards.
Well,
cashback.
I don't do that stuff very well. Like credit cards and reward points or anything like that. I should, but I don't do. I just haven't signed up to anything. But yeah, progress often accumulates with little wins, and then the big wins happen. And hopefully, by the time the big things happen, we're not that excited by them because, Bitcoin has slowly become ubiquitous in our daily lives. And so, yeah, don't be such haters out there, And the other thing that happens is when a really large player buys, there's people on the timeline lamenting the fact that BlackRock's buying more or Strategy's buying more. And so, you can't win with some people.
Yeah, but I think the good news about this, and I think it was Max Kaiser, he lamented about this, right? But the good news is, you can't control Bitcoin, the protocol itself, with supply. You can manipulate the price, right? But of course, only once to the downside, because at some point you run out of Bitcoin, right?
Yeah.
That's the good news. Even if like BlackRock and other major financial institutions continue to accumulate supply and continue to concentrate supply, I think it doesn't really change the game, right? It's actually good because it widens adoption, because it's not like BlackRock or any kind of ETF issuers buying for themselves. They're fiduciary. They're buying for millions of people, right? And so you actually get an acceleration and adoption, right? Which is good. We want to see a broader usage of Bitcoin, right? You don't get hyper Bitcoinization by staying in the basement, right?
I agree with almost everything you said, but I guess there's a point I should raise just for discussion, if not disagreement, is that I do think if you get to a certain scale of Bitcoin ownership, you develop a cultural clout that then can be parlayed into influence over protocol development, various BIPs being adopted and the like. And, you can lean into that if you like. So, Saylor has enormous cultural clout within the Bitcoin space. He's earned it, in my view. Whether or not everyone agrees with, him having that level of influence is up for debate, but who cares? BlackRock certainly has financial clout. They don't really have any cultural clout within Bitcoin, but they have financial clout. And it was implied by Nick Carter, and I hope I don't get this wrong because I haven't slept well and it's off the top of my head, but I think he implied that if Bitcoin core devs did not address the quantum computing so-called threat, that was somehow at an unknowable proximity, but possibly sooner than people think. They could use the threat of not just selling, but perhaps favoring a hard fork over one maintained by Bitcoin core devs. What do you think about this whole? Well, first of all, do you agree with me about ownership does infer some kind of cultural clout, and maybe that could be used in some ways to sway developer initiatives and what's accepted in that sense, but also then the financial clout, the threat, perhaps not ever outwardly expressed, but it's there that they would favor one fork over another with their financial clout, and that would result in a lot of people making the choice with them.
100%. I mean, you can get influence with money, right? Mm-hmm. But there are pros and cons, right? Mm-hmm. Let's take quantum risk, for instance. We actually donate 10% of our profits from BITB, from the Bitcoin ETF, to Bitcoin core developers, right? And the good thing is suddenly they have financial resources to work on things like quantum, right? Mm-hmm. We also funded Presidio Bitcoin, which is like a San Francisco-based kind of meetup for Bitcoin devs, where they talked about quantum risks in the summer last year, right? Mm-hmm. And so there are pros and cons. The pro is, of course, they have more financial resources. They can work on problems that are really important, right? Like quantum. But of course, you have some kind of higher influence. But the good news is because you have decentralization and you have these kind of checks and balances within the Bitcoin ecosystem between developers, node runners, and miners and users themselves, right? Mm-hmm. Even like if there's some kind of Bitcoin improvement proposal or new version, right? We've seen it with Bitcoin Core V30. It doesn't necessarily mean that it will see lots of adoption, right? To the contrary, right? The most recent V30 example is a prime example, right? You saw many users staying with like V29 and waiting for a new version, right?
But isn't that quite common that a new version takes time to propagate through all the nodes and for people to, I guess, observe and agree with it and before they adopted that? Doesn't that usually
Yes, of course. Yeah.
Okay.
It doesn't necessarily mean, even if you have influence, for instance, on core devs, right? It doesn't necessarily mean you can really change the protocol, right? That just highlights this example, underscores this example. And and even miners, they can choose to mine on a different kind of protocol, like knots, right?
So the criticism is that nothing's being done on quantum. What do you think about that?
I think something's being done, right? We've just seen that the BIP 360 has been uploaded to the repository.
That's a relatively recent.
It's a very recent
Was it
development.
2 weeks or maybe 3
yeah,
weeks?
It's very recent, yeah.
Okay.
But something's being done. We can also talk about quantum, whether it's like a true risk or whether it's BS.
Yeah, let's get into it. Yeah.
So I think it's a true risk, but it's more about timelines, right? And I think the FUD centers around Q-Day. That is, it's nearer than most people think, right? That's why we should act now, should upgrade to quantum-resistant signatures, and so on. But I think it's farther away.
How can we know that, though?
So consider the following kind of rationale. So, for instance, many quantum experts actually agree on the fact that you need at least 1 million physical qubits for quantum to become a threat to Bitcoin. And we are around, I think, 1,000 qubits right now. So I think based on this, you need at least 9 doublings to reach 1 million qubits from thousands. And let's assume you follow Moore's law, right? You get a doubling in efficiency every 2 years. So you need 18 years to reach that level, right? If you follow Nevin's law, which has been observed in terms of quantum computing efficiency, it's double as fast as Moore's law. You still need 9 years, right? So it's between probably 9 to 18 years away, but not like 2 to 5 years away, I think.
How does AI change that calculation with the ability of AI to solve new problems in and of itself?
I think that's one of the key theses, right? We now have AI thinking about quantum computing. That's why the whole development will even accelerate, right? And there's definitely risk to it. But what is ultimately the risk? Let's say we don't upgrade to quantum-resistant signatures before Q-Day. Then, of course, the whole supply is at risk. But even if you assume, okay, it's 5 years away, so per year you have like a 20% discount on the price of Bitcoin, right? At each additional year, you get like 20% more discount, 20% more discount, because you have to discount the price, right, for that risk.
Can I just stop you there? Isn't that the wrong way to think about risk timelines? That it's 5 years away rather than within 5 years. It's at any one point it could probably manifest a solution.
That's probably the reason why we front ran, let's say, 5 years in a matter of 5 months almost, because you could make an argument that current quantum discount is around 30% based on the relative performance between Bitcoin Cash and Bitcoin Core, BTC.
Yeah.
Because Bitcoin Cash, they have a more ambitious quantum roadmap. I think they'll move to quantum-resistant signatures in May this year, so in a couple of months. That's why I think you rather see this kind of discount. So if you look at the relative performance starting in Q4, when we had like peak quantum uncertainty, up until now, it's around 30% underperformance. And you could argue, okay, this hypothetically implies like a 30% quantum discount, right? But let's say it's like 100% discount in 5 years' time. So each year, 20% discount. But we front ran 1.5 years in like 5 months, That's why I think even if Q-Day was nearer, it's still an overreaction in the short term, because that quantum discount has been discounted too fast, I think.
I think back to 3 years ago before the launch of ChatGPT, and I wonder what the projections were for AI. And I imagine a day before ChatGPT was launched, they would have been, far out into the future than they were subsequently the day after it was launched. But even still, for the next 12 months or so, we had most models, even 18 months or 2 years even, most models more or less just becoming faster versions of one another before we started seeing in the last 3 months, 4 months, models take real huge leapfrogs ahead of the pack, At one point, Grok was leading in just about everything after coming from nowhere. And then, we see Claude come out of nowhere to take the lead in coding. And then this sort of agentic model comes out. Was it Claw, OpenClaw or whatever it's called now?
Cloudbot.
That's just an application of the LLM, right? But it suddenly enables a whole bunch of applications and productivity tools in a way that's more accessible to people like me and also developers to be able to put them to use as well. And so now we've got AI working on AI as well. So we've had a number of AI experts say that we pretty much let AI write most of the code now. It's working on itself. And so that accelerates everything. And so I'm just using those last 3 years as an example for what may be possible in quantum. I know quantum seems like something that's quite far out, and I take what you've said about even if we're discounting, for the next 3 or 5 years, nothing happening or the potential for something happening within 5 years, the market's overreacted in the short term, if it in fact has reacted to that, I think. I'm not convinced of that yet. But in terms of technological development, the leapfrogs that technology can now take, especially if problem solving is one of the bottlenecks in quantum computing, which I presume that's what's holding people up. They may have the theories on how to develop quantum computers capable of breaking Bitcoin and the like. But doesn't AI significantly accelerate all of that now, or at least make it so difficult to quantify a timeline that all we know is that all previous timelines are going to be compressed by some unknown factor? And doesn't that make everything more urgent? And I just ask these questions just from a philosophical point of view because I have no technical pedigree whatsoever to understand the conversation. But I see what's happened in AI, and I'm thinking, why won't that just compress all our timelines with respect to quantum computing risk to Bitcoin?
I think AI models, they're based on historical data, meaning past data, right? And innovations, you have to anticipate the future for innovations, right? And move the edge, right, of technology. So I'm not sure whether the fact that AI is thinking about quantum actually implies that we'll get there faster, because they only use the information we have right now. Of course, if they become more creative, and also start connecting the dots faster than we can, right? And they can do this, right? Because they have access to all kinds of research papers. They can accumulate this or aggregate this knowledge, right? And connect the dots and then suddenly lead maybe to new conclusions. But I'm not sure about this, to be honest. So it doesn't, the fact that AI thinks about this doesn't necessarily imply that we'll get faster innovations, in my view.
The reason why that question comes up is I'm starting to see people who are saying AI is solving novel problems or problems in novel ways, both, in fact. Whereas previously it was the answer that you'd just given me is it can pretty much tell you what's already been done or solve problems that are very well defined within a domain. But now I'm hearing people say, actually, no, it's coming up with novel solutions to new problems. I'm like, okay, this is all a bit sort of breathtakingly wild for me to comprehend what the consequences are. And so, I don't know. I see Adam back on the timeline say, it's all right, we're on it, we're thinking about it. And, I don't have the pedigree to even have the conversation, to have an opinion one way or the other. But I just look at it just from a principled point of view. If AI can condense all its developmental timelines on itself, couldn't it do that in a different domain? I guess it remains to be seen. So since we're talking about AI, one of the interesting and exciting use cases for AI is it needs a currency. AI needs a currency. And so more and more it's looking like that currency could and logically should be Bitcoin. Have you looked into that? Have you done any sort of work on that? And what do you think?
I think it's true. If you ask AIs directly, any kind of AI, ChatGPT, Cloud, Grok, or any kind of major AI, they all say the same thing. they prefer Bitcoin, right, as the currency of choice. And they know about the problems of fiat monies, right? And I think the key reason is also permissionlessness, right? Because it's hard for them to essentially create or have access to fiat deposits, right? Dollar deposits, euro deposits, or whatever, right? But they can easily create a Bitcoin wallet, right?
Yeah.
Or stablecoin wallet, because it's permissionless. And that's why I think it's most definitely the likeliest candidate for being the currency for AIs, right?
How far away are we from being able to do that? From being able to empower AI agents to use Bitcoin seamlessly? And I know now developers are doing that. I've seen examples of that. But how far are we from me spinning up a Claude bot on the cloud using some service and then it just having access to a tool to enable Bitcoin payments?
I think it's
Can
already
do that
happening.
now.
Yeah, I think Coinbase has just announced that they've rolled out wallets specifically for AI agents.
Wow.
So I think we're there. It's just a matter of time. And I think in terms of the growth in that area, it's insane. I've never seen anything like it.
That's really interesting because now what we're seeing is that these agents are being empowered with tasks. Someone will say, go set me up a website. All right? To set up a website, you've got to buy a domain. You've got to get hosting. You may have to buy some software, various plugins. Now, all of these things have to be bought online. So that means all of the merchants who provide servicing for those products and services online have to quickly enable Bitcoin payments like pronto, or they're going to miss out on all this agent-driven business, which could quickly amount to billions of dollars as an industry. I mean, how quickly could we get to $5, $10 billion, $100 billion worth of business for agent-driven transactions? I imagine that could be pretty quickly. Because if we're empowering them, if we are going to empower them to then, end-to-end take care of these sorts of tasks, and we don't want to interfere with their decisions to purchase a domain or whatever, they need the money to be able to complete the task. And these services have to enable Bitcoin payments. A lot of them don't yet do that. So that could be a huge boon for merchant adoption.
Have you checked like the users on Cloudbook, it's called, right? Like the social network for AI agents.
Maltbot.
A Maltbot,
yeah. Something like that, yeah. Maltbot.
And it increases by, I think, 1 million new agents almost every week.
Wow.
But it's probably accelerating right now as we speak.
Do we know what the total is?
I think it's a couple of millions already.
A couple of millions at least. So, because it's only been 3 weeks or something since it launched, right? It's phenomenal. If that's the case, we can get to 100 million, like if we just assumed exponential growth.
It's even faster than exponential.
Wow.
That's why I said, like, I've never seen anything like that. Because on a log chart, it goes essentially vertical.
Yeah.
Just goes upwards. So
let's just say 100 million within 6 months. 100 million agents, right?
Yeah.
That's not...
It's incredible.
Yeah. How much are they spending? If they all spend $10 each on average, that's $1 billion. They're spending more than $10, right? Like even just to spin up a basic website is more than $10, right? So, we're talking multi-billions. And if all of these digital services companies want the money, they need to be able to facilitate Bitcoin transactions, right?
That could be one of the wild cards for 2026, right? We talk about all kinds of catalysts. When is price going up? I think one of the key positive catalysts is definitely quantum risk. Once we resolve quantum risks, you could essentially instantly get rid of this kind of discount, right? Let's say it's 30%. So hypothetically speaking, if that was the case, right, then Bitcoin would rally by 50% instantly, right? To catch up, like to close this kind of discount. Maybe ETF buying, I think is still one of the key catalysts, because we talked about ETFs being the dominant force in the market, right? And so on. If you look at the data, it's true. If you look at, for instance, net in and outflows into ETFs and what is called spot volume delta on exchanges, essentially like buying minus selling volumes on exchanges, it correlates almost 1-to-1, right? So I think they've become the dominant force on exchanges. And we've just seen the green light by major wirehouses in December. It didn't happen like...
Talk to us about that. First of all, tell us what a wirehouse is and what is the significance of major wirehouses in the United States giving the green light to Bitcoin?
It's very significant because most of the distribution of financial securities goes via these wirehouses. And what do you mean by wirehouse? It's the big banks, right? It's like banks like Wells Fargo, Morgan Stanley, Bank of America, and so on. And I know for a fact, so Wells Fargo, they've greenlighted Bitcoin ETFs for their financial advisors. And they have a horde of financial advisors. They have tens of thousands financial advisors across the country that are now able to distribute Bitcoin ETFs to their clients. And why is that big? Because Wells Fargo alone has, I think, $4 trillion in client assets in their wealth management division, which is huge, right? And it's just one wirehouse, right? So you're talking about trillions of dollars that is now accessible. Of course, it won't be like 100% allocation. Probably will be like 1%, 2%, 3%. I think we do like an annual survey among financial advisors and how much they'd allocate. And I think the most recent number was between 1% and 5%. So let's say 3%. But 3% of like a couple of trillions is still a lot of capital, right?
Yeah. Especially if it comes in the space of like 18, 24 months. That's quite a flood of funds, right?
Yeah. And so that's why they're so significant. And I wouldn't be surprised if like Bitcoin starts grinding higher at some point throughout 2026 and narrative comes after the fact, after price has moved already, right? And then we realize, we get like consistent inflows. Because what we also realized, we just published a research piece on what is actually driving Bitcoin ETP flows and ETF flows. Right?
Yeah.
What's the main driver? So we looked at the VIX, right? So risk aversion in equities. We looked at DVOL, like the implied vol on Bitcoin options, right? We looked at things like the basis rate, also other flows into other financial assets like the SPY or TLT ETF. And what we found out, we did all kinds of tests, and many of these variables were very significant, also causal in terms of Granger causality. But then we did like a model which included flows itself, past flows, past performance, and all of these variables like VIX, other kinds of ETF flows, and so on, also lagged. And we found out once you include flows itself, past flows, and past performance, all of these variables are insignificant. That means flows follow flows, and flows follow performance. It's that simple, right? It's just there's such a persistence in flows.
So that means if allocation begets allocation, right? And the rest is if the market's up. Funds flow into ETFs. And if the market's down. I mean, I've noticed that correlation as well, because inevitably, whenever Bitcoin was up, you'd look and you go, okay, the flows have been positive, but they weren't big enough to influence the market. For example, like $500 million inflow into ETFs it's strange to say it, isn't it? That's not going to drive the price, because how many billions are traded every day?
I think we made a calculation, was a couple of maybe last year or the year before. For every 1 percentage point increase in Bitcoin ETP AUMs on a global basis, so European ETPs, US ETFs, and so on, for every 1 percentage point increase in AUM, it's associated with 1 percentage performance increase.
It is?
Yeah.
Okay.
On a weekly basis.
Okay.
Exactly. So it's almost 1-to-1. So, and I mean, global Bitcoin ETP AUM are around $200 billion right now. But still, we have so many potential pools of capital that can move into Bitcoin ETFs still, right, at this point in time, that can 3x, 4x this number, right, easily, right? If you think about 401ks alone, right, we've just seen that executive order last year, right, that 401ks are able to invest, and 401ks plus defined contribution plans in the US, like 12 trillion US dollars, you know?
And so, it's a lot of money.
That's a lot of money, yeah.
Why would a sovereign wealth fund like Abu Dhabi's buy BlackRock's IBIT instead of taking self-custody?
It's easier. I think it's easier for them to do it.
But they're a sophisticated investment organization, right?
Yeah, and but custody, like self-custody, sounds trivial, but it's not. Right? If you do it on a professional level, right, with multi-sig, you need to have like trained in-house personnel, right? It's not like you can just do it. I mean, probably we could do it.
Yeah.
But there are also pros and cons, right? So the moment you do self-custody in-house, you expose yourself to theft risk, damage risk, fire risk, for instance. Key person risk maybe, right? So all kinds of different risks. Of course, you mitigate counterparty risks, because you could argue, the funds are not safe with IBIT or anything. But they are, of course, it's segregated money, right? It's just fiduciary money. And most of this is insured anyway, even with Coinbase and so on. So they have extra insurance. The custodians have extra insurance. And so I think, and it's also cheap, right? Because, I mean, what do investors pay for IBIT? 25 pips, right? 25 basis points,
something
so
like
0.25%. If, let's say, you'd insource custody, you'd probably have way more costs, right? In terms of settlement, trading, right? You need like traders to trade Bitcoin, right? So extra personnel to deal with custody. If you start in-housing all that stuff, right? Yeah. And so I think one of the key reasons is price, right? It's rather inexpensive, and you essentially outsource custody, which is, it sounds trivial, but I think it's rather complicated.
So if the sovereignty is not the deciding factor for you, but financial exposure to Bitcoin is, and you don't want to deal with the custody element, for a large financial institution, I guess an ETF makes a lot of sense, as it does for a lot of other people, of course. That's not music to the ears of a maxi. You know, for some reason people assume, Michael Saylor's going to walk around with a hardware wallet in his back pocket or something. But I mean, it does make sense for an institution to do that. I just wonder at what level does it take on the role of gold, where, many nations want to custody. They want to hold their own gold. At what level does Bitcoin take on that kind of significance? Is it at the Reserve Bank, central bank level, the sovereign wealth fund level, or are they just basically another investment institution that just, we're interested in financial exposure, not necessarily the anti-counterparty risk?
I can tell for a fact that both sovereign wealth funds and central banks, they buy via the ETF.
Really?
Yeah. What we're seeing is the only players in the market that tend to do self-custody and tend to do their own trading in-house are usually private banks, mostly Swiss-based private banks. I don't know why, but they tend to prefer doing it in-house and holding the Bitcoins themselves. Maybe their clients demand it. I don't know what's the reason behind this, but I've just seen a couple of private banks preferring self-custody over the ETF solution.
I've got to be honest, I thought with the pedigree of Switzerland's private banks that they would become a dominant force within Bitcoin. And maybe they are, and I'm just ignorant to it because I'm not, involved that deeply in that part of the industry. But it doesn't seem to me like they are. Is that right?
Yeah, I think Swiss banks, they are somewhat dominant. They hold a large chunk of AUM, at least also in Bitcoin ETPs. They are major Swiss issuers as well. In fact, so the story about Bitwise in Europe is we essentially got acquired by Bitwise US, right? before the acquisition, we were at ATC Group, and we issued the very first Bitcoin ETP on the Frankfurt Stock Exchange on Xetra in 2020. And then it was actually quite fortunate because we did it before the crazy run-up, at the end of 2020. But there was a Swiss-based issuer that issued in 2019 already. It was the very first in Europe. And so the Swiss were essentially first in this kind of business as well. And if you look at adoption rates, Bitcoin adoption rates, and crypto in general, I think the Swiss next to the Dutch have the highest adoption rates in Europe. I think it's above 20% in Switzerland, same in the Netherlands. Germany's around 10 to 15 right now. I think UK is also in that ballpark, 10-ish%. But France, relatively low. Spain's also between 10 and 15%. So the Swiss were, I think, quite advanced in terms of their Bitcoin adoption from very early on. And I think they're definitely somewhat dominant because they've been so early. Maybe it has to do something with their kind of hard money mentality, because I think Switzerland had a hard money standard until 1995 or so, right?
Did they?
Yeah, they had a gold standard into the 90s, I think. And then they also got rid of the gold standard. And they had I think a couple of referenda already on whether to move to a 100% fractional reserve system.
How did they vote yes on that? I would have thought they'd be financially...
They didn't.
Okay.
They actually voted no. There were some initiatives in Switzerland. I think there's some kind of hard money mentality.
Yeah.
And I think they also gift for birthdays or special occasions, they gift these Swiss gold coins, right? Vernellis. And it's it's a very unique Swiss thing, I think. Yeah.
The Dutch, that's an interesting one, that they've got adoption levels rivaling the Swiss, who were, I guess they lead Europe in Bitcoin adoption. But what's driving that in Holland?
I have no idea. Probably open-mindedness in Holland, Netherlands. But I'm not sure. Probably that might change with the unrealized tax change. But
that seems to be something that's coming up more and more in discussions. And I think
it's economic suicide.
Thing. Yeah, it is.
I think it's. I actually, from a fiscal side, I don't really see the need why they should do that. I think I'm actually quite puzzled by this move.
It's not necessarily needs driven. Some of it is we've had probably 20 years of accelerated monetary debasement and Cantillon effects, and people, a lot of people now, not just young people, we're talking people under 45 who've not been able to buy a house.
Yeah.
Many of them, as a result, haven't started families. Don't underestimate, and I'm not saying it to you, but people do underestimate the amount of resentment that's built up because of that. And subsequently an embrace of policies, not even out of political ideology. Historically, people would have had some kind of disposition towards one ideology or another for all sorts of reasons, right? Perhaps cultural, perhaps economic, whatever. Now we've just got an entire generation being more or less open to policies like this because of the resentment they have to people who did well out of the Cantillon effect. And unfortunately, a lot of people, most of the wealth that we see from older generations is a function of the Cantillon effect robbing the subsequent generations. And so I'm looking at that, I'm like, I disagree with the policy, but I understand the resentment. I understand it. I think it's legitimate. They've been screwed. People have been screwed by policy. And now we're seeing the backlash to that. And I don't think we have the language or even the framework in the political discourse to be able to deal with that in a functional way. I just think there's a lot of trouble ahead.
I think the whole discourse is also completely misdirected because we know it's most likely due to the monetary system itself. You talked about the Cantillon effect, right? The loss in purchasing power is obviously related to money printing, right? And inflation. And so, yeah, also understand the resentment, and I think it's justified because housing prices, especially asset prices in general, they've appreciated way more than wages, right? Wage growth was way lower, and that's why you've seen this kind of decoupling, and eventually like unaffordability of like basic needs like shelter, right? That's why I also understand this resentment. But like increasing taxes, it's not the solution.
It's not.
Right?
It's not going to solve anything, and that's why I'm saying like it's because it's driven by resentment. People don't really care about the efficacy of it.
Exactly.
They care about punching someone back.
Exactly. Yeah, punishing
right?
like the benefit.
It is a punitive measure.
Yeah,
it's a punitive measure, and not only that, it's going to be completely dysfunctional. But I'm like, in some ways, the whole sort of buy, borrow, die mentality of sort of asset acquisition, I get that. And if there was some kind of policy that was functional and they wanted to tax the borrow part of it, it's like, okay, well, you might have like 100% unrealized capital gain, but we're not going to tax that. But if you borrow against it, that's a form of realizing your wealth, activating that. I'm like, okay, that might be a little bit more pragmatic. Not that I would agree with it, but I could see what the thinking is. But to tax 100% of unrealized gains, I don't understand that. So it's just like people are going to sell and you're going to have a crash in markets, and it's going to be disastrous. Who's going to want to invest in anything?
Yeah, and it's the typical Laffer curve, right? At some point, if you increase the tax rate above a certain threshold, you get less taxes on aggregate.
Wasn't that specifically to income tax, or was it taxes in general?
Personal income tax.
Personal income tax. But I think this is much more destructive than that. It's going to go to the heart of capital formation, incentivizing, and then like
and migration away from from the Netherlands, right? I can already tell that there's a guy called Alessandro Palombo, and he talks a lot about like different kinds of jurisdictions and stuff, and like tax optimizations and stuff. And I think he posted a tweet saying like, I had many like Dutch people reaching out to me already, in order to like relocate from the Netherlands to mostly Dubai, UAE, and like other like more tax friendly places, right? It will be, I think, disaster for the Netherlands because I think it will backfire. It's this kind of Cobra effect, right? They want to increase tax revenues. Yeah. Right? But they will probably end up with like less taxes.
Every single boomer with their second and third house or whatever. Now, I'm not defending the acquisition of or the collection of properties to the exclusion of people who need to raise families and all the rest of that. But like if you've got properties and suddenly you need to sell them to fund your tax liabilities, what's that do to the market? You're going to crash the housing market. What does that do to employment within the housing industry? Most countries have like almost 10%. It will also
kill like the banking channel, because what usually happens is most of the banking assets are comprised of real estate loans, right? And also real estate collateral, right? Yep. If like the value of the collateral declines, they'll extend less and less loans because they will become more risk averse. If they have like declining asset values and also declining equity values. So I think it could really backfire, right? Especially via this kind of real estate channel, banking channel. And
do you think they want that? Do you think
on purpose
that it's such a destructive sort of mentality that they're like, yeah, let it all burn. Why not? We don't own it.
I don't know. What's this kind of razor called again?
I don't know.
Don't attribute to...
to malice.
Yeah, exactly.
What is incompetence?
Exactly. It could be incompetence, right? You never know, right? And it could be related to political motives as well, which are not necessarily rational.
No.
Right? It's just trying to get reelected. Right? It's a different kind of incentive. And so it doesn't need to be right for the whole population, right? Or the whole economy. Yeah. It can be wrong, but maybe it's good for the politicians itself, right? In order to get reelected, to get votes. Because they're fighting against this, they're actually catering to this kind of resentment, right?
Yeah. I don't see any good options for people. I want to talk about. We've spoken about AI. We did, didn't we?
We did, yeah.
Very briefly, but we didn't talk about the. Okay, I did confess that I am a bit of a doomer when it comes to AI. As an entrepreneur, I'm incredibly excited. But when I sort of look at what I think is going to happen on the macro scale, as a citizen, I'm not terrified. I'm very sad at what's about to come. And I've mentioned this to other people, and they use the analogy of previous technology waves, that there will be new industries and new jobs created and the like, and I don't see that. Not because I can't anticipate what those industries and jobs can be, but in principle, whatever the work is, I think robots paired with AI will be able to do it one way or the other. If it's an intellectual capacity, it's going to be some model of AI. If it's a physical requirement, it's going to be AI paired with robotics in some way to more or less take over all kinds of labor. That doesn't leave a great deal of space for humans to seek future employment. And we can't all be entrepreneurs. You're just not going to get billions of entrepreneurs. That's just not going to happen. So I don't see where the optimism is. I can see in the immediate sense there's going to be enormous cost savings, huge profit margins, and there's going to be a sort of fake optimism and euphoria around that in financial markets. When I say fake, the prices will rise, stocks will rise.
K-shaped economy.
But then demand is going to collapse.
Yeah, exactly.
Because, robots don't really need too much, do they? So I just think the vast majority of people are not going to have purchasing power. So what happens there? I can't figure it out.
I mean, the doom scenarios we move towards like UBI and like a 2080 kind of society, right? We have like a 20% elite or creators, influencers. Right?
I don't even think it'll be like 5%.
Even less?
Yeah, I don't see 20%. There's no way I see 20% of people. Like I've worked in a lot of companies, right? I was a consulting contractor. Most people are not doing work, right? Like I could easily take a team of management accountants, and within 2 years, I can see AI doing all of their jobs. So there's 10 management accountants gone. Because I know all of their roles. I've seen them. I've worked with them. I've seen their outputs. Most of the time, they're staring at a screen or a spreadsheet. That can be, automated so fast. You don't really need them there. But you might need one or two senior management accountants to oversee sort of that process and the outputs. They're all gone, right? People who do sales analysis, reports, which is, a lot of an organization. People who do PowerPoint presentations. They're all gone. And most jobs are basically Word, Excel, and PowerPoint. They're all gone. I don't see it.
It's true, yeah.
I don't see
I was
those
actually
people.
terrified. Or it was a mixture of being terrified and aha moment. I think it was Clout. They have this kind of update where they, I think, implemented an add-in to PowerPoint, right? And you can just upload a random spreadsheet with data and prompt to like create a PowerPoint presentation based off these data.
Yeah.
And they will create a whole PowerPoint presentation based on raw data, which is incredible.
Interpret it and tell the story.
I mean, it's probably, in terms of layout, probably doesn't look right at first, but of course that can be optimized over time, right?
Yeah.
And I was, terrified and at the same time Yeah, I had this kind of aha moment again.
There was a few roles where I built performance sort of management reporting models, right? I was reliant on a guy who had to get me the data, right? That guy's job's gone. It doesn't need him, right? That can just be an agent-to-agent thing, right? The reporting model that I built at various places that, took me from 1 month to 3 months, depending on the complexity, that's done in 5 minutes now by an AI. I just tell it, build me a cash flow model or a sales reporting model. It's done in 5 minutes to a high standard.
High standard, yes.
Right? And so suddenly, okay, you might still need someone like me overseeing that, but instead of 3 months of work, you can bring me in for a week and get that all done, sorted, socialized, get all the stakeholder buy-in and training, all that sort of stuff.
So if I put on my tinfoil hat, where does this leave us?
I don't know.
So let's say it's a 595 society.
Yeah.
With like just leadership roles.
I think we go back to serfdom.
Maybe some kind of neo-feudalism, right? And I mean, if you look at the most recent developments in terms of CBDCs, right? And digital IDs and so on, I mean, you could imagine a kind of scenario where this actually becomes reality, right?
Yeah.
And it's actually quite terrifying.
I think that's exactly what's going to happen. So Elon Musk has said something about universal high income or whatever. We're all going to share in the spoils. And I'm like, no, it's not. That's not going to happen. First of all, we don't even have the language or the political framework in a discourse to be able to talk about these things without being, called fascist bootlicker or commie socialist this or that. And it doesn't even we just quickly resort to Cold War era stereotypes of you're either one of these or one of those. Hang on, no. We're all in this literally together. I know that's been a catchphrase of the UK Conservative government when they were in power, but we literally are this time because if you count on getting wealthy, you're not going to be able to enjoy being wealthy in a society like a dystopian society. So what happens then? I think Elon is not tracking the rate of change and progress through a framework of property ownership. Because he's like, AI is going to be able to do all this and generate so much abundance. And go, yeah, but who's going to own that abundance? Who's going to own the machines and the robots and the energy? And right, we have a system of property ownership that will determine who gets the outputs.
That's right. Yeah.
And it's not going to be the people without money.
It's going to be the shareholders.
It's going to be the shareholders. And I'm not saying that's wrong. I'm saying it's just going to deliver an outcome that's going to be catastrophic if we don't come up with some new way of dealing with this. And I don't know what the answer is, right? And I can just hear the screams of people wanting to invoke sort of Marx and all these. I'm like, you can do that if you want, and it's going to lead you down a sort of dark tunnel. I want to talk about solutions, not ideologies. What are the solutions? We're going to have hungry people and homeless people. How do we solve that problem? Right?
Good question. Yeah.
You solve it by figuring out a way for them to be fed and
especially
housed.
How do you solve the financing, right? If more and more people are reliant on the state sector, right, not the private sector, for income, it needs to come from somewhere.
Yeah.
And at the same time, you'll have probably less and less private sector employment and so on. So you'll have more concentration in monopolies, mega caps, right, that own that stuff, right? So they need to be taxed to finance it, or you need to raise more debt, right? You need to issue more debt, which is also not sustainable. So both taxation of like the remaining winners is not sustainable because they might do jurisdictional arbitrage, they might move somewhere else, right? And debt issuance also not sustainable because who's going to pay for that debt, right?
There's no good answer.
You'll need some kind of reset, monetary reset, And
but we still have a framework of property ownership, which I agree with, by the
Yes,
way. I don't want to
of
do
course.
away with all I'm saying is I'm just presenting the fact that I can't reconcile what I see that's going to happen with our current reality being able to facilitate something that's going to be harmonious in the future. I see catastrophe. And I'm not advocating for the destruction of property rights, okay? I'm not doing that. Don't be stupid.
Yeah, me neither.
But what I'm saying is, given our current understanding of how to exist in society, I don't see a solution. So I don't know how we negotiate our way through that, because our political system's dysfunctional, our discourse is dysfunctional. It's extremely limited. All of these things,
But
that's why I'm a doomer.
Where does this leave Bitcoin? So we know, I mean, by asking the AIs directly, that Bitcoin and probably stablecoins are the preferred currency of choice, right?
Mm-hmm.
Mostly Bitcoin, right? Where does it leave Bitcoin? Probably in a very good position.
Very good.
As like the digital gold alternative, pristine collateral, savings vehicle. If the shareholders own the AIs and the robots who own Bitcoin, right?
Yeah.
It's ultimately the shareholders, right, who own Bitcoin as well.
Well,
But,
just on that point is really interesting, because I think the first reaction by policymakers will be to print and print and print.
Yes, of course.
That's what their first reaction will be.
Because at some point, due to the Laffer curve and due to like jurisdictional arbitrage, which we're already seeing, right? I mean, UK is a prime example. Many UK residents, millionaires in particular, they're moving out of the UK, moving to Dubai or UAE mostly, right? So taxes are declining, right? How do you make up for this? You can't like increase the tax rate. You'll create even more resentment, right? So what's the only solution? Is more debt issuance, but that's also unsustainable. Who's the buyer of last resort? Central bank, right? So you need to print, right? At some point, I mean, all roads lead to money printing, right? And that's also the bull case for Bitcoin, right? On a global scale as well, right? Because the West and even China faces a very similar problem, which is high fiscal debt, right? All at once. I mean, Japan, UK, US, right? France, Italy, many major countries have like above 100% debt to GDP ratios, right? Japan above 200%, 250%, I think.
Yeah.
So it's definitely not sustainable. And I think at some point, especially in the case of the US, there's definitely a scenario where you have so much capital flight, right, that the central bank needs to step in and buy the treasury bonds. And I think that's one of the key scenarios that Ray Dalio has also mentioned. Because what usually happens at the end of this kind of cycle, fourth turning cycle, is debt monetization, right, by the central bank, because nobody wants to hold that stuff anymore. So it will accumulate on the central bank's balance sheet. And I think that's also the end game. Let's say Japan is like the blueprint, right? It's highest in terms of debt to GDP ratio.
Yeah.
It is most advanced in terms of demographics, right? They have literally like declining population, right? Their central bank owns, I think, 70% of JGBs already. They own like the majority of Japanese government bonds already. And you could actually, what's quite funny and also interesting, you could actually manufacture a kind of reset via the central bank. You could eradicate all of the debt at once by buying up all the debt. All the sovereign bonds end up on the central bank's balance sheet. And then what you do is, and you can do that as a central bank because you're not like restricted by accounting rules, IFRS or anything. They can essentially account how they want right? But they do abide by certain accounting rules, but just for the sake of it, they don't have to, right? But what they could do is they could convert these bonds to perpetuals without coupons, so zero coupon perpetuals, and still mark them at at par, 100%. That's based on like the book value, but the market value of these things is actually zero.
Right. So
because
why would anyone buy them then?
Exactly, a bond that pays no coupon
and
that has no maturity, no expiration, it has a zero value, right? Because you lend out money, you don't get anything back. Zero value, right? So theoretical market value is zero. So you destroy all these bonds, right? So wipe off that debt. But you essentially refinance the whole fiscal side, right? Because you still bookmark at 100. So the state has received these 100, right?
From the central
face
bank.
value, they have received the face value from the central bank.
Okay,
right?
okay.
Because they bought it, right? But they account for it on their balance sheet. They essentially wipe it off.
How is it that basically the government can borrow from itself like this, as if the central bank has this black hole from which all the debt can just go into? And why don't they just do a reset, like a hard reset, without these sort of paper shuffling games?
Because I think what many people don't know actually is the state doesn't have monopoly over money creation. It's like the government doesn't create the money.
The banks do.
It's the bank. It's the commercial banks and the central bank, right? That's where like money comes from. And the state has to either raise taxes or issue debt, right? They can't just create it, which is like a paradox. But I think there are only a couple of countries that actually do directly create government money. I think it's even Guernsey. Is it like Guernsey in the Channel Islands?
Yeah. When the government prints money, so let's use the United States as an example. The Fed did print, say in 2008. Where did they get the $800 billion from?
They just created.
They just created that, right?
Because
so that's the government creating that.
No,
wasn't
it's
the banks.
The Fed. It's the Fed. The central banks. It's separate from the government, right? It's, of course, you have laws that connect, like oversight by the government, like the election of the Fed governor and so on. So there's some connection, but it's like the central bank's balance sheet is different from the fiscal balance sheet, right? And the capabilities of these balance sheets is also very different, right? The government just can't create money like this, right? It can only borrow debt via the banking system, financial institutions, by issuing debt. But it's a zero-sum game, right?
So if the Fed bought all the government debt and then it went poof into a black hole, and the very next day we create a new entity called the Central Fed instead of the Fed.
They start anew, of course. They can still operate because they don't mark to market, right? They convert this kind of debt. They just keep it at 100.
Yeah.
Nothing changes, right? And so they can keep doing this, right?
It's such a confidence trick, isn't it? It's a little bit like...
The moment they did this, I think that there's probably like a huge kind of depreciation in the currency or anything. I think it's not without consequences. But
so I agree. Like, my family, my parents are from Turkey. Turkey's had, was it 3 or 4 monetary resets, right? I think a lot of Bitcoiners think that when a currency fails, that's it, Bitcoin's ready to take over. And that's not really what happens, because if there's still a functional state, the state still has, enough confidence of its population to then just reset the currency and start again. Turkey's done that like 3 or 4 times. Argentina's done that, And so it's not necessarily the case that the United States fails or the US dollar fails and then no more US dollar. It'll just be like US dollar 2.0. It will just, as if nothing happened, it will just continue as
Yeah,
we start the game again.
The positive thing about this kind of scenario is the fiscal side's completely clean, right? No debt whatsoever anymore, and they can start anew. They can start issuing new debt, right? And suddenly, because they don't have to pay these kind of interest rates, because like the Fed has just converted these bonds into zero coupon bonds, right? They don't have to pay these interest rates, interest expenses either anymore. And like currently, I think the interest expense around $1 trillion per year. It's a lot, right? It's a big hole in like the fiscal expenditure side. So suddenly they don't have to pay these interest expenses anymore. They probably can reduce taxes as well because they don't need so much revenue anymore because they have less expenses. And so I think the cycle can start anew. And I think that is like, that's just my personal opinion, but I think that's the end game essentially.
There is one enormous cost to the United States that Turkey never had, and that's losing reserve currency status. The United States. Do you think the US dollar will then automatically lose reserve currency, global reserve currency status, or do you think there will still be remnant confidence in I don't know how. I know it sounds ridiculous as I'm about to say it, but just for the sake of discussion, do you think there will still be enough confidence in the United States and demand for its treasuries after a currency reset?
Let's say we move towards a non-debt-based system, right? Or more like a fully backed kind of system.
No, I just think we reset and it just goes straight. We just start again, the same game.
Exactly, but let's say we're moving away from treasuries being like the primary reserve asset to gold or Bitcoin. Then you can still have lots of confidence if the US government backed their currency with Bitcoin or gold, right? It doesn't necessarily need to be backed by debt, right? By US treasury bonds.
But in that case, any government anywhere in the world can say, well, we're backing our currency with Bitcoin as well, so why do we need your treasury bills?
Yeah, exactly. Why do we need the dollar, right?
Yeah.
But I think we're moving towards a world where you have like a dichotomy, right? You have probably like fiat-based stablecoins, right, as medium of exchange, and Bitcoin as the primary store of value, right? In like distant future, right? Because if we're really honest, right? I mean, Bitcoin hasn't really taken off in terms of like this medium of exchange story, right? Not yet, right?
Nor as a store of value. It's not globally recognized as a store of value. It's still recognized as a speculative emergent asset.
I mean, if Bitcoin was like, if we all were on a Bitcoin standard, right? Of course, then it would be both store of value and medium of exchange, right? Because we'd have like everything in Bitcoin, right? All kinds of deposits, all kinds of wealth in Bitcoin. In fact, if you look at emerging markets like Latin America, right, or Argentina, or like probably Turkey as well, right? People use stablecoins a lot, right?
Yeah.
Dollar stablecoins in particular. I think dollar stablecoins are so dominant. I think they have like 99% market share, right? There are a couple of euro-based stablecoins, but they're nothing in comparison, like the dollar stablecoin market. And so I think we're moving towards this dichotomy: stablecoins as a medium of exchange, primary medium of exchange, primarily dollar stablecoins, and Bitcoin as a store of value. But I don't think that Tether will be like the only stablecoin available. I think many banks will essentially issue their own stablecoin. So you won't have bank deposits, you will just have stablecoins. Right, so you move away from this kind of traditional deposit-based system to more like stablecoin system. And then the question becomes like, how do these stablecoins back their liabilities, right? These token issuances. I mean, if you look at Tether's balance sheet, they bought a lot of T-bills at the beginning, right? Then they bought Bitcoin, but now they're bought gold, right?
Yeah.
So they have a mixture of different assets that is backing like this dollar sale coin. Question is still like, who's going to win? But I think, of course, because T-bills are way inferior to both gold and Bitcoin as a store of value, I think it will ultimately move towards a hard asset as a kind of anchor,
Yeah. I get the feeling the United States will try to have his cake and eat it too when that time comes. I don't know when. And I think they want to extend that time frame, push it into the future as much as possible. Of course, Japan has done it for, is it almost 50 years? Or
they
40
had that,
years, right? Late 80s, early
exactly.
90s.
In the late 80s, they had this massive crash, right?
Yeah.
And then
so
I think they
say
started
36 years they've gone, right? So this game can play out for a long, long time, and they never had global reserve currency status. And so it's a big thing. I think what China has done is to gradually, very gradually, to move away from US dollar hegemony. And that could play out over 50, 60, 70 years for sure. I don't think a collapse is imminent. But, maybe we don't need a collapse for Bitcoin to take prominence, right? Maybe just massive quantities of printing every 5 years.
I think it's a race in terms of timing. So I think the fact that most of the gold has been accumulated in China, and essentially the fact that the gold price rallied is actually a testimony that the US can't control the gold price anymore. If you're into this kind of gold
I see. Yeah.
conspiracy theory, right? But it's well documented actually. So there's been lots of gold market manipulation via COMEX and US exchanges, right? I think the fact that gold is able to rally like this, for me, is a testimony that they're not able to control the gold price anymore, that the control is in China. And so I think the only card, and probably that's the card they're playing or trying to play, the only card that the US has right now is to establish a Bitcoin reserve, right?
Well, that's
and
the idea.
Move away from gold and suddenly say like, oh, we're establishing a Bitcoin standard. We're backing our treasuries with Bitcoin, not with gold anymore. We're actually selling gold to buy Bitcoin budget neutrally, right?
Yeah. Well, that's the idea people are pushing, is that the US government is allowing the gold price to run. They want it to run up to 20,000, at which point they will sell their reserves, if they even have them, their unverified reserves, and then they will move to a Bitcoin standard. So they will use the run-up in the gold price to pay off their debt. I don't think that's going to happen. Like, they don't need to pay off their debt. They can just default. And if they're going to lose reserve currency status anyway, why would they pay off the debt? Why wouldn't you just default, reset your currency and keep the 32 trillion in gold?
Yeah.
Like, why would you pay it off?
But we don't know whether they still own these 8,000 plus tons, right? Metric tons of gold in Fort Knox. We don't actually know. There's been no audit. And
why do you think they want to keep that? Okay, if they have it, why would they keep that a mystery?
The only explanation is they don't have it anymore, right? Because, and I think was it parts of this Epstein file revelation?
I haven't seen that one.
I think there was a piece of information, but it's incomplete and is also somewhat circumstantial. But nonetheless, there was a statement, I think, was by Dominic Strauss-Kahn. He was the former head of the World Bank, and he mentioned, I think he made he alluded to it, that like Fort Knox might be empty, right? But
was that before or after the hotel incident? Because there's a sort of conspiracy that
that's
not that he didn't do it, but that he was lured into doing something that was then used against him.
I think it was before.
You know what I'm talking about, right? Yeah.
But I'm not sure whether it's connected. Anyway, but I think there was some kind of revelation in this context. Remember, there was actually a plan to audit Fort Knox, right? But it didn't happen.
Whose plan was that?
I think Elon even mentioned it.
Oh, with the Doge thing.
Yeah, with the Doge thing and everything.
And it's not there.
And it didn't happen, right? And so, and I think if you're into this kind of gold bug community, they've been saying it for decades, right?
Yeah.
They've been saying I think it was like a guy called Paul Craig Roberts. That guy, he explained the whole gold market manipulation, the mechanics behind it. And the way he describes it is major banks in the US, they did naked shorts on COMEX futures, which manipulate the price lower. And then they could buy back physical gold for delivery for these futures contracts by buying the SPDR gold ETF. But behind these buyings of these futures contracts, many times were Asian buyers, Chinese buyers. And that's how physical gold actually migrated from the US to China over time. You can't manipulate the gold price forever.
No.
And so, but that's like the mechanics like Paul Craig Roberts describes. And they've been doing it probably for decades, right? But this kind of theory implies that gold reserves have been depleted over time, right? And could be one of the reasons why Fort Knox is empty, or close to being empty, right?
Shouldn't you be able to just do the numbers based on production reserves everywhere around the world except for Fort Knox? And then I guess if global reserves are increasing beyond production, you can make a fairly confident prediction.
It's hard to tell because
is it all
gold has been around for millennia, right? So it's not like you subtract consumption from production and then you get the inventory and where it ends up, because there's so many sources of demand. There's central bank buying, there's jewelry, then you have recycling, which adds to the existing production as well. It's too complicated on a global basis, so I think it's hard to derive these kind of numbers.
Just before we go, just let people know where they can find you on Twitter and websites and etc.
So I'm relatively active on Twitter. That's how you found me, right? My handle is Andre_Dragosch. Also on LinkedIn, not so much on Nostr. Shame on me, but I have an account, but I'm not so active. I've also written a book. Maybe that's also worth mentioning.
What's it called? Yeah, tell us about it.
It's called Exponential Gold. And it's an institutional investor's guide for Bitcoin and crypto assets. And it includes a whole history section, financial history section at the beginning. And also moves into practical allocations into Bitcoin.
Where can people find that?
You can buy it on Amazon.
Exponential Gold.
Exponential Gold. Or you just type in exponential-gold.com and lead you to the right place.
Andre, it's been a pleasure. Thank you so much for coming into London. I really appreciate the effort you've made, and it's been a wonderful chat. Hopefully the first of very many, and you're welcome back anytime you're in London.
Thank you so much. Yeah, thanks for the invitation.